To truly assess the quality and sustainability of a company's growth, shrewd investors delve much deeper than surface-level figures, scrutinizing specific financial statements and metrics. One of the most telling indicators is GAAP or IFRS-compliant net income. These accounting standards ensure a consistent and transparent reporting framework, providing a reliable measure of actual profitability. This is in stark contrast to non-GAAP metrics like adjusted EBITDA, which can often be manipulated to paint a rosier picture than reality by excluding various expenses. Beyond reported profits, the most critical metric for uncovering genuine financial health is cash flow from operations. While net income is an accounting measure that can be influenced by non-cash items and revenue recognition policies, cash flow from operations reflects the actual cash generated by a company's core business activities. A company with strong net income but weak or negative operating cash flow might be relying on aggressive accounting practices, selling off assets, or taking on excessive debt to sustain its reported profits, which is a major red flag for long-term viability. Conversely, consistent and growing cash flow from operations, particularly when it exceeds net income, is a strong signal of a healthy, repeatable business model capable of self-funding its growth and expansion without constant reliance on external capital. Ultimately, the pursuit of sustainable value is about building a business that can generate consistent returns for its stakeholders over the long haul, not just fleeting success. This requires an integrated analytical approach that goes beyond single metrics. Companies that create sustainable value typically exhibit several key characteristics. Firstly, they possess repeatable business models that ensure consistent revenue streams and predictable cost structures. This means their growth isn't a one-off event, but a result of entrenched processes and customer loyalty. Secondly, efficient working capital management is crucial. This involves optimizing the use of current assets and liabilities, such as managing inventory effectively and collecting receivables promptly, to maximize cash flow and minimize financing needs. A company that needs to constantly borrow to fund its day-to-day operations despite growing revenue is not sustainable. Lastly, strategic capital expenditure, CapEx, plays a vital role. This refers to judicious investments in assets that enhance future productivity and expand capacity, rather than wasteful spending. By focusing on these elements, repeatable models, efficient working capital, and strategic CapEx, businesses can achieve consistent shareholder value creation, mitigate risks, and position themselves for enduring success, proving that quality of growth truly triumphs over mere quantity of growth.